and diaspora composition, India. Join us in Afro-Wealth Creations as we X-ray the impact of diaspora remittances on Africa's lessons from India. Introduction. Diaspora remittances have become a critical lifeline for African economies, contributing to household welfare, economic stability, and development finance. As globalization facilitates greater mobility, many Africans have migrated abroad, sending back significant sums of money to their families and communities. In fact, remittances to sub-Saharan Africa $49 billion in 2022, playing an essential role in reducing poverty, funding education, and improving access to healthcare. At the same time, India stands out as the largest recipient of remittances in the world, receiving over $100 billion annually. A large diaspora in countries like the United States, the Gulf states, and Europe, India has leveraged remittances not only to support individual households but also as a pillar for national economic growth. By examining India's successful experience in managing diaspora remittances, African countries can learn valuable lessons to optimize the inflows and economic impact of their own remittances. This essay explores the impact of diaspora remittances on Africa's economy and identifies lessons from practices that Africa has the potential of its diaspora more. Would you like to continue with this structure or explore specific sections in more detail? Let me know how you'd like to proceed. Landscape. Remittances are financial flows sent by migrants to their home countries, often through formal or informal channels. These funds have become an essential source of income for many developing nations, particularly in regions like South Asia, Latin America, and Sub-Saharan Africa. Remittances help support households, alleviate poverty, and in some cases, contribute significantly to national economies. Global trends. The global remittance market has experienced steady growth over the past few decades. In 2022, remittance inflows were estimated $626 billion worldwide, with India, Mexico, the Philippines, and Egypt topping the list of recipients. Sub-Saharan Africa, though home to many of the world's poorest nations, remains a significant recipient of these funds, with countries like Nigeria, Kenya, and Ghana receiving substantial remittances from their diaspora populations. Impact on developing economies. Remittances offer several developing economies. They provide a stable source of foreign exchange, which can help stabilize currency values, reduce reliance on international aid, and create an alternative to volatile foreign investment. Remittances are a critical tool for improving living standards, education, healthcare, and housing, as well as launching small businesses. Additionally, in times of economic downturns, natural disasters, or political instability, remittances often prove to be more reliable than foreign direct investment or development aid. They tend to be counter-cyclical, meaning that they can increase during economic hardship, offering a safety net for recipients. Africa's diaspora remittance landscape. Major remittance receiving countries in Africa. In Africa, remittance inflows are concentrated in a few major economies. Nigeria, the continent's most populous nation, is the largest recipient of remittances, accounting for over 50% of adult remittances, which stood at approximately $49 billion in 2022. Egypt, Kenya, and Ghana also feature prominently in the list of top recipients. Countries like Zimbabwe, Senegal, and Uganda also depend significantly on remittance inflows, especially from Europe, the United States, and the Middle East, where much of their diaspora resides. In some cases, remittances surpass official development aid and foreign direct investment, highlighting their importance. Economic significance. In many African countries, remittances constitute a significant share of GDP. For example, countries like Lesotho, Comoros, and Gambia, remittances account for more than 50%. These funds often go directly into household consumption, helping families pay for education, healthcare, and housing. The direct household impact is particularly evident in rural areas, where formal financial services are limited, and remittances often serve as a lifeline. Families use remittances to improve their living standards, invest in small businesses, and build assets, such as homes and land. Key sectors impacted by remittances. Education. Remittances are often used to pay for school fees, uniforms, and other educational materials, ensuring that children have access to better opportunities. Healthcare. In regions with limited access to public health care, remittances fund private medical treatment, improving the well-being of recipient families. Housing. A significant portion of remittances is invested in housing, helping families build or renovate homes, which contributes to the construction industry and generates local employment. Agriculture. In rural areas, remittances often fund agricultural inputs, machinery, and land acquisition, boosting productivity and food security. Informal channels and their impact. One challenge facing Africa's remittance landscape is the prevalence of informal remittance channels. These can include hand-carrying cash across borders, or using unregulated money transfer agents. While these channels may be faster and cheaper, they often lack transparency, and remittance recipients face higher risks of fraud and loss. Furthermore, informal channels make it difficult for governments to track the actual volume of remittances entering the country, complicating efforts to leverage these funds for broader economic development. The Indian remittance model. A case study: India's historical migration and diaspora composition. India has one of the dispersed diasporas in the world. Indian migration patterns can be traced back to the 19th century, when the British colonial government sent indentured labourers to various colonies. Over the years, Indian professionals, skilled labourers, and students have migrated to countries like the United States, the United Kingdom, Canada, and the Gulf states, creating a vibrant and influential diaspora. Today, India's diaspora is known for its significant contributions to the global economy. Many Indians abroad occupy high-paying jobs in sectors like information technology, healthcare, engineering, and academia, which allows them to remit large sums of money to their families in India. India is the largest recipient of remittances. India has consistently been the largest recipient of remittances globally, with inflows exceeding $100 billion annually. The Gulf countries, the United States, and the United Kingdom are the primary sources of remittances to India. This inflow of funds has been a stabilizing force in India's economy, providing liquidity and bolstering foreign exchange reserves. Role of the Indian government in facilitating remittances. The Indian government has been proactive in facilitating remittances by offering a range of financial products and services tailored to the needs of the diaspora. The Reserve Bank of India, RBI, has ensured that the remittance process is reduced transaction costs and fast processing times. Additionally, India has launched initiatives such as the Pravasi Bharatiya Divas, an annual event that recognizes the contributions of the Indian diaspora and encourages them to invest in India's economic development. Various have also been issued to channel remittances into productive sectors like infrastructure and education. Economic impact of remittances on India. Macroeconomic impact. Remittances in India have contributed to macroeconomic stability by enhancing foreign exchange reserves, stabilizing the Indian rupee, and reducing reliance on external borrowing. These funds have also helped cushion the Indian economy against global financial shocks, as remittances tend to be more stable and counter-cyclical compared to direct investment, FDI. Household level impact. At the household level, remittances have lifted millions of people. The funds sent by India often used to improve living, purchase assets, and invest in healthcare of family members. Remitto enabled rural households to access financial services, which in turn fosters savings and investment. Sector-specific impact. Real estate. Remittances have fueled a booming real estate market, especially in urban areas. Many Indians working abroad invest in property in their home cities, contributing to local economic growth. Banking. The inflow of remittances has expanded the banking sector, with financial institutions offering specialized services for remittance recipients. Healthcare and education. Many families use remittances to pay for healthcare and education, which enhances human capital and drives long-term economic growth. Comparative analysis. Remittances in Africa versus India. Remittance volumes. India consistently outperforms Africa in terms of remittance inflows. While Africa receives around $49 billion annually, India alone surpasses $100 billion. This difference can be attributed to India's larger and more skilled diaspora, which earns higher incomes abroad. Demographic and migration trends. Indian migrants tend to be more concentrated in high-income countries, especially in in sectors like IT and healthcare, where wages are higher. In contrast, many African migrants are employed in low-wage sectors, especially in the Middle East and Europe, leading to lower average remittance amounts. Remittance channels. India has a more formalized remittance infrastructure, with the majority of remittances flowing through regulated banking channels. In contrast, countries still rely heavily on channels, which can be less secure. Institutional support. The EU has implemented several policies to encourage remittances and engage the diaspora, such as offering diaspora bonds and creating dedicated institutions to manage remittance flows. Are still in the early stages of developing similar frameworks. This overview provides a solid foundation. If you'd like, I can continue elaborating on the rest of the sections to build out the complete essay. Let me know how you'd like to proceed. Challenges and barriers to maximizing remittance impact in Africa. While diaspora remittances represent a significant source of income for many African economies, the continent faces several challenges in maximizing the potential benefits of these financial inflows. These barriers stem from structural issues in financial systems, high transaction costs, reliance on informal channels, and socio-economic factors. 1. High transaction costs. One of the most prominent challenges in Africa's remittance landscape is the high cost of sending money. According to the World Bank, the global average cost of sending remittances is around 6%, but in sub-Saharan Africa, this figure is higher, reaching an average of 8 to 10%. These costs often include fees for money transfer services and unfavorable exchange rates, which diminish the amount received by recipients. Several factors contribute to these high costs. Limited competition in the remittance service market, with players such as Western Union and MoneyGram to set high fees. Lack of infrastructure for financial services, especially, which makes it expensive for operators to provide remittance services. Regulatory post-compliance costs, such as anti-money laundering, AML, financing, CTF, requirements. This issue is particularly detrimental to small remittances, much of the transfer is consumed by fees. Addressing these costs is crucial for maximizing the economic impact of remittances in Africa. 2. Regulatory and financial infrastructure challenges. Many African countries lack the robust financial infrastructure needed to efficiently manage and maximize remittance inflows. For example, a significant proportion of the population in sub-Saharan Africa remains unbanked, especially in rural areas. Without access to formal banking services, recipients often rely on informal remittance systems, which come with higher risks of loss or fraud. The inefficiencies in financial infrastructure also lead to delays in money transfers, poor service quality, and inflated costs. This has a direct impact on the capacity of remittance recipients to utilize these funds in a timely manner for productive purposes such as business investments or savings. 3. Informal remittance channels. In many African countries, a large portion of remittances are sent through informal channels, such as money carried by friends or relatives, unlicensed money transfer operators, or hawala systems. These informal mechanisms are often preferred because they can be cheaper or faster than formal channels. However, they come with several disadvantages. Lack of security and reliability, as money can be lost or stolen during transit. Difficulty in tracking remittances, making it challenging for governments to accurately measure remittance inflows and their impact on the economy. No regulation or protection for consumers, which increases the risk of fraud and exploitation. Formalizing remittance channels by creating more accessible and affordable banking and financial systems is key to harnessing the full potential of remittances in Africa. 4. Limited financial literacy. A significant challenge in leveraging remittances for economic development is the limited financial literacy among recipients. Many remittance beneficiaries, particularly in rural areas, lack the knowledge and skills to manage funds effectively. Instead of using remittances for savings, investments, or productive ventures, many recipients spend them on short-term consumption needs, such as food, clothing, or household items. While meeting immediate needs is essential, the long-term economic impact of remittances could be much greater if recipients were educated about financial planning, savings, and investment opportunities. Lack of financial literacy also limits the use of formal banking services, perpetuating the reliance on cash-based or informal transactions. 5. Currency volatility and inflation. Many African countries experience high levels of currency volatility and inflation, which can erode the value of remittances. For example, in countries like Zimbabwe, where inflation rates are persistently high, the purchasing power of remittances can diminish significantly by the time they are received. This volatility reduces the real value of remittances and makes it difficult for recipients to use the funds for long-term investments. It also increases the risk for migrants, who may hesitate to send money home when exchange rates are unfavorable. 6. Economic and political instability. Many African countries experience periods of political and economic instability, which can disrupt the flow of remittances. Conflicts, poor governance, or economic mismanagement can lead to deteriorating banking systems, shutdowns of money transfer services, or restrictive policies that make it harder for the diaspora to send money home. For instance, in countries facing internal conflict, such as Somalia or South Sudan, remittance flows can be impeded by the destruction of infrastructure or the imposition of sanctions. This makes it harder for families in these regions to access much-needed funds, exacerbating poverty and limiting economic recovery. Lessons from India for Africa. India provides a wealth of lessons for African countries seeking to harness the full potential of remittances for economic development. With over $100 billion in annual remittance inflows, India has managed to build a robust system that maximizes the benefits of its diaspora's contributions. 1. Reducing remittance. One of the key lessons from India is the reduction of transaction costs associated with remittances. India has leveraged partnerships between the government, the private sector, and financial institutions to offer competitive remittance services. For example, Indian banks have established partnerships with major international money transfer operators to streamline the remittance process and reduce fees. Additionally, India's financial institutions offer specialized remittance products tailored to the diaspora, such as NRI, non-resident Indian bank accounts, which offer favorable exchange rates and lower fees. African countries could adopt similar measures by promoting competition in the remittance market and encouraging partnerships between banks and remittance service providers. 2. Formalizing remittance channels. India has successfully encouraged its diaspora to use formal banking channels for remittances by offering secure, reliable, and affordable services. Initiatives like RuPay, India's domestic card network, and the Unified Payments Interface (UPI) have simplified digital transfers, reducing reliance on informal channels. African governments could adopt similar digital payment systems to formalize remittance flows. By expanding access to banking services, especially through mobile money platforms, Africa can shift more remittances from informal to formal. Countries like Kenya, with the success of M-Pesa, have already demonstrated the potential of mobile money to facilitate low-cost remittances. 3. Financial inclusion and literacy programs. India's focus on financial inclusion has been instrumental in ensuring that remittances are not only received but also productively used. The Pradhan Mantri Jan Dhan Yojana (PMJDY), a financial inclusion program, has helped millions of Indians, including remittance recipients, open bank accounts. This has improved financial services, enabling families to save, invest, and plan for the future. African countries could implement similar initiatives to promote financial inclusion and literacy. By ensuring that remittance recipients have access to affordable and reliable banking services, governments can encourage the productive use of remittances for savings, investment, and business development. 4. Diaspora bonds and investment vehicles. India has successfully issued diaspora bonds, such as the India Development Bonds (IDBs), which have raised significant funds for national development projects. These bonds provide the Indian diaspora with a secure investment option while contributing to the country's infrastructure and economic growth. African countries could explore similar mechanisms by issuing diaspora bonds to fund critical sectors like infrastructure, education, and healthcare. This would allow the diaspora to contribute more directly to national development while also earning returns on their investments. The role of technology in enhancing remittance flows. Technology plays a crucial role in optimizing remittance flows by making transfers faster, cheaper. Both India and several African countries have embraced technological innovations to improve remittance services. 1. Mobile money and fintech solutions in Africa. Mobile money platforms, such as M-Pesa in Kenya, have revolutionized the remittance landscape in Africa. These platforms allow individuals to send and receive money using their mobile phones, bypassing traditional banking infrastructure. This has made remittances more accessible to people in remote areas, where banking services are limited. Fintech solutions are also helping reduce the cost of remittance competition in the money transfer market. Startups like WorldRemit, Sendwave, and Chipper Cash are providing lower-cost alternatives to traditional remittance providers, particularly for Africa. 2. Digital payments in India. India's digital payment, led by the Unified Payments (UPI), has transformed how processed. UPI allows seamless, real-time transfers between bank accounts using mobile phones, reducing the reliance on traditional banking systems and lowering transactions to facilitate faster and cheaper remittances. By integrating mobile money with digital banking platforms, governments can create a more efficient remittance infrastructure. This is a detailed continuation of the essay. The next sections will cover further policy recommendations, the conclusion, and the future outlook for remittances in Africa. Let me know how you'd like to proceed. Policy recommendations to enhance the impact of remittances in Africa. To fully capitalize on the potential of diaspora remittances as a key driver of economic development in Africa, governments, financial institutions, and international organizations must adopt targeted policies. Several areas of reform can significantly increase the efficacy of remittances in stimulating economic growth, reducing poverty, and promoting financial inclusion. 1. Reducing transaction costs. High transaction costs continue to be a major barrier to maximizing remittance inflows in Africa. Governments can take several steps to reduce these costs, promote competition in the remittance market, encouraging more players, especially fintech startups, to enter the remittance market can drive down costs by fostering competition. Governments can reduce barriers to entry for remittance service providers and streamline regulatory processes for new entrants. Partnerships with digital and mobile payment providers. Expanding partnerships between banks, mobile money platforms, and digital payment companies can enhance the efficiency and affordability of remittance services. This is particularly important in countries where mobile money is widespread, like Kenya, Tanzania, and Uganda. Regulatory harmonization, streamlining cross-border regulations, and reducing compliance burdens can make remittance services more affordable. African countries could work through regional bodies, such as the African Union, or regional economic communities, e.g., ECOWAS, SADC, to harmonize financial regulations. 2. Expanding financial inclusion. Improving access to financial services is key to maximizing the impact of remittances. Governments can implement policies that enhance financial inclusion for remittance recipients, mobile banking and fintech solutions, encouraging the adoption of mobile money platforms, particularly in rural areas, can help individuals without access to traditional banking services receive remittances more easily. Expanding mobile money infrastructure and incentivizing banks to develop mobile-based services can be transformative for rural populations. Encouraging bank account ownership, governments could incentivize the opening of formal bank accounts for remittance recipients through targeted programs, such as tax breaks or subsidies for low-income households. This would help move more remittances from informal to formal channels, increasing transparency and improving financial inclusion. 3. Formalizing informal channels. Given that many remittances in Africa are sent through informal channels, governments should focus on formalizing these transactions to ensure they contribute to national development goals. Some steps to consider include public awareness campaigns, educating migrants and their families about the risks associated with informal remittance channels and the benefits of using formal services, could help shift remittance flows to the formal sector. Incentivizing formal transfers, offering lower fees for formal remittance channels or tax breaks for recipients